Every single day, money is constantly moving from people who are actively saving to the people and businesses that desperately need those funds. This movement is absolutely crucial and helps our local businesses grow, creates jobs, and essentially strengthens our entire Filipino economy. Welcome to today's Explainer. Think of me as your friendly university lecturer as we explore the foundational mechanics of our financial system and really discover how these structures connect everyday savers with borrowers. Okay, so here is our roadmap for today. We are going to be moving step by step, starting from the macro flow of money in the economy, all the way down to the micro level of human psychology in the markets.
Let's jump right into part one and look at the big picture, how capital actually moves around in a well-functioning economy.
Take a moment to digest this definition on screen. The capital allocation process is quite literally the engine of economic growth. In a healthy economy, money needs to flow efficiently from the people who have extra funds straight to those who need those funds for investments and business activities. Because without this flow, businesses just couldn't expand, and innovation would completely grind to a halt.
Now, this beautifully illustrates the two main players in our financial ecosystem. On one side, you have the suppliers of capital. These are individuals or institutions with excess funds who are looking to earn a solid return. On the flip side, we have the demanders of capital. These are the folks who need to raise funds to finance their opportunities, and they are willing to pay a return to get it. To put this into a real-world perspective for you, imagine Teacher Juan down in Davao. He manages to save 100,000 pesos from his salary. He's our supplier. Meanwhile, Maria wants to expand her local sari-sari store, but she lacks the capital. She is our demander. Through the financial system, Juan's savings can eventually end up funding Maria's business.
So how does that money actually get from Juan to Maria? Capital flows between these players in three distinct ways. First, you have direct transfers. This is simple, like if a family member lends 50,000 pesos directly to a relative wanting to start a food business. No middlemen. Then you have investment banks, which specialize in helping big corporations raise capital from investors. And finally, financial intermediaries. For instance, when a major commercial bank, let's say BDO, accepts deposits from everyday savers and then turns around and lends that exact money out to local entrepreneurs, it's acting as a classic financial intermediary. All right, let's move on to Section 2. Let's see how all this builds our understanding of the specific venues and players involved when this money changes hands. Think about a physical market where you exchange cash for fruits and vegetables. A financial market is very similar, except here, venues exchange surplus cash for future returns. And keep in mind, financial markets don't necessarily exist in physical locations anymore. Today, massive amounts of transactions happen entirely online, like when you buy and sell shares digitally through the Philippine Stock Exchange. The really crucial point here is that it's not just one big monolithic market. Markets come in many highly specialized forms. You have physical asset markets for tangible things like real estate and financial markets for stocks and bonds. We use money markets for short-term debt and capital markets for long-term investments. There are even spot markets for assets you buy today versus futures markets for assets you agree to buy at a later date. The whole system is incredibly diverse to meet very specific economic needs. Now, a really specialized tool within these markets is the derivative. Just like the name sounds, its value is derived from the price of something else, like an option or a futures contract. You can use derivatives to reduce your risk, which we call hedging. Imagine a Philippine tech importer buying currency futures to protect their business against a falling peso. Or derivatives can be used to speculate. Speculators are basically betting on the future direction of prices. If they guess right, the returns are massive. But if they guess wrong, they face massive losses. To facilitate all of these incredibly diverse markets, we rely on these key financial institutions acting as the middlemen. From the everyday commercial banks holding your checking account to massive institutions like the SSS or GSIS managing our pension funds, each one plays a highly unique role in pulling money from the suppliers and funneling it straight to the demanders. Let's shift gears a bit and zoom in on one of the most famous financial venues in the world, the stock market. I want you to really think about this scenario for a second. If a major company, let's say Apple, issues brand new stock and you buy it, what kind of transaction is happening there? Primary or secondary? Did you get it right? Whether it's a global tech giant like Apple or a local heavyweight like SM Prime or Jollibee, if they are creating and issuing brand new shares, it's a primary market transaction. The company itself is actually receiving your capital. But if you just logged into your online brokerage account today and bought existing shares from another investor on the open market, that's a secondary market transaction. The company doesn't see a single peso of new money from that. The shares are simply changing hands between investors.
So, going public through an IPO is the ultimate primary market transaction. It enables a company's private owners to raise serious capital from a massive pool of outside public investors. Once those initial shares are issued, the stock then begins trading back and forth in the secondary market.
What's really fascinating here is seeing how those secondary market transactions are tracked in real time on global exchanges. Look at this snapshot of Twitter, which is now X. You can see the constant real-time fluctuation of the price, the bids, the asks, the daily range. At any given second, millions of shares are changing hands globally, with buyers and sellers all trying to figure out the exact fair value of the company.
For our final section today, let's look at how efficiently all these markets actually operate and how unpredictable human behavior impacts them. So, if markets are highly efficient, it means prices already reflect every piece of available public information. The absolute second news breaks, the market instantly digests it and adjusts the stock price. Because of this, securities are considered to be fairly priced, which means trying to consistently outsmart the market is nearly impossible for the average investor without sheer luck or inside information. This historical chart of the US S&P 500 vividly shows that long-term equilibrium. Sure, you might see wild swings from year to year, with some massive gains and some crushing losses. But over decades, it consistently averages out. Just like our local PSEI, this proves how incredibly hard it is to consistently beat market averages over time, reinforcing that markets are just remarkably efficient at pricing in data. Let's apply this new knowledge to a real-world scenario. Let's say you're watching the evening news and you hear a tip about a medical company passing regulatory hurdles, or maybe a super exciting new IPO is announced. Should you immediately drain your savings account to buy in? The short answer? No. By the time you, the everyday retail investor, hear the news, it is almost always too late. Large institutional investors and trading algorithms have already bought and sold on that regulatory approval within fractions of a second. As for those hot IPOs, unless you're an institutional insider getting a ground floor allocation, the track record for small, late investors buying in on day one is rarely favorable. Yet, despite all this mathematical efficiency and instantaneous data processing, we have to remember one fundamental truth. Markets are still driven by humans. And humans? Well, we are not exactly perfectly rational calculators. This brings us to a really fascinating field called behavioral finance. It studies how we actually evaluate risks completely differently when we're making money versus when we're losing money. It shows how we get stubbornly anchored to our own existing viewpoints, even when brand new data proves us completely wrong. So I'll leave you with this final provocative thought for today's explainer. If financial markets are supposed to be perfectly efficient mathematical machines, how much of our global financial system is actually just driven by totally irrational human psychology? It's a profound question to keep in mind as you continue your studies. Thank you so much for joining me today.